This week, one shock changed the whole market. War-driven disruption in the Strait of Hormuz sent oil surging, inflation fears roaring back, and rate cut hopes fading fast. We break down the Fed, ECB, and Bank of England response, rising bond yields, the pressure on SPY and QQQ, Nvidia's correction, and the key macro events that could decide what happens next. Welcome back to the weekly market recap. Let's start with the story that hit almost everything at once. During the week of March 16th through March 20th, the sharpest driver was the new escalation in the war involving the United States, Israel, and Iran, and the threat it posed to shipping through the Strait of Hormuz. That waterway normally carries around 1/5 of global oil and liquefied natural gas supply, so when flows were disrupted, markets immediately priced in a real energy shock. Brent pushed above $100 a barrel during the week and briefly touched $119 intraday on Thursday. By Friday, Brent settled at $112.19, while U.S. crude finished at 98.32. Natural gas also jumped, and suddenly the market was no longer talking about smooth disinflation. It was talking about fuel costs, shipping risk, and a new inflation pulse landing right into an already fragile global growth backdrop. That mattered because oil was not just an energy story. It became a policy story. Higher crude and gas prices raised the risk that fuel, utility, and transport costs would keep headline inflation hotter for longer, just as investors had been expecting easier central bank policy. The cross-asset reaction was classic risk-off. On Friday alone, the S&P 500 fell 1.5%, the Dow dropped 470 points, and the Nasdaq lost 2%. Treasury yields also moved up, with the 10 years near 4.39% and the 2 years near 3.89%, showing traders were rethinking how quickly rates could come down. In the UK, the FTSE 100 fell 1.4% to 9918, and 10 years gilt yields briefly moved above 5%. In other words, one geopolitical shock spilled straight into inflation expectations, bond pricing, and equity sentiment. So the real change this week was not geopolitical tension in the abstract. It was the concrete jump in attacks on energy infrastructure and shipping, which turned a regional conflict into a global market event. Credit spreads widened, defensive positioning picked up, and the old soft landing narrative gave way to stagflation fears and recession anxiety. And that leads straight into the next big question for markets: how central banks responded once this new shock hit. After the week's war-driven oil shock, the next big test came from the Federal Reserve. On March 18th, the Fed left its policy rate unchanged at 3.5 to 3.75%, and that mattered because some investors had been hoping for a more clearly dovish signal. Instead, Chair Jerome Powell stressed that uncertainty was still elevated and said the implications of Middle East developments for the U.S. economy were uncertain. The vote was not unanimous either. Stephen Moran wanted a quarter-point cut, while the rest of the committee backed a hold. So the message was clear: the Fed was not ready to promise quick relief. Powell then filled in the numbers behind that caution. He said unemployment was 4.4% in February, total PCE inflation was 2.8%, and core PCE, which strips out food and energy, was 3.0%. He also said near-term inflation expectations had risen in recent weeks, likely because oil prices had surged after supply disruptions in the Middle East. The Fed's new projections still showed the median policy rate at 3.4% by the end of 2026 and 3.1% by the end of 2027, unchanged from December. That did not endorse the idea of rapid cuts. That is why the market read this meeting as firmer than hoped. Rising oil, firmer inflation expectations, and a steady median rate path made the Fed look more two-sided, not more eager to ease. By the end of the week, yields were higher, equities were softer, and the focus shifted to whether other central banks would also sound more cautious. After the Fed came Europe, and the message was just as uncomfortable. On March 19th, the European Central Bank left all three key rates unchanged, but it also made clear that the Middle East energy shock had changed the outlook. The deposit rate stayed at 2%, the main refinancing rate at 2.15%, and the marginal lending rate at 2.40%. Christine Lagarde said the war had made the outlook much more uncertain, with higher inflation risks and weaker growth risks arriving at the same time. The new staff forecasts showed why markets paid attention. The ECB now sees headline inflation at 2.6% in 2026, 2.0% in 2027, and 2.1% in 2028. Growth was projected at just 0.9% in 2026, then 1.3% and 1.4% in the next 2 years. Lagarde also noted that euro area inflation had risen to 1.9% in February from 1.7% in January, while core inflation moved up to 2.4% from 2.2%. That is not a clean disinflation story anymore. That shift mattered far beyond one meeting. Investors had to reprice Europe for a harder mix of sticky inflation and weaker activity, with pressure on rates, cyclicals, and consumer sectors. And from there, the focus moved directly to London, where the Bank of England had to respond to the same energy shock. After the ECB, the Bank of England delivered an even sharper warning for markets. On March 19th, it kept bank rate unchanged at 3.75%, but the tone was far more hawkish than investors expected. The Monetary Policy Committee said the Middle East conflict had pushed up global energy and commodity prices and would lift near-term inflation. It also warned about second-round effects, meaning higher energy costs could start feeding into wages and domestic prices. The details explain the reaction. The bank said UK CPI was 3.0% in January after 3.4% in December, but expected February to come in a little above 3%. It then projected CPI close to 3.5% in March, about half a point above its February report. For the second quarter, it now saw inflation around 3.0% instead of 2.1%. And it said third quarter CPI could reach as much as 3.5% once direct and indirect energy effects were added. This led to a sell-off in UK gilts and a stronger sterling. Investors began to consider the risk of another rate hike rather than focusing on cuts. It was a clear reminder that energy shocks can quickly make central banks sound more hawkish. After this scene, we will continue with our detailed chart analysis as we do every week. We start with SPY because the S&P 500 is now clearly in pullback mode. This chart marks a fresh 5% plus pullback low on Friday, March 20th, with the drawdown sitting around 6.7% from the swing high. That tells you the broad market is no longer just wobbling inside a range. It is registering a deeper risk-off move that fits the tone of the whole week. If the oil shock and tighter policy backdrop keep feeding caution, this kind of pullback can stay the market's main reference point until buyers prove they can stabilize it. Now tactically, SPY is sitting right on support near 648.57, and the latest candle does respect that line. But the rest of the chart still leans defensive, with price below the 20 days, below the 50 days, below the 200 days, and RSI down near 29.6 while volume stays elevated. So yes, a bounce is possible from this lower channel zone, but the market is still trading like sellers have the edge until that support starts producing real follow-through. If the macro shock eases, this is where a relief move can begin, but a clean break below support would keep the bearish trigger active. Zooming out, the bigger message is that the long trend has not fully broken, but it is under real strain. The 50 days average is still above the 200 days, so the golden cross structure is technically still there. Yet price has already slipped below the 200 days by about 1.8%. That is a much weaker position than last week because the bullish structure now looks fragile instead of comfortable. And that is the perfect handoff into QQQ, because once the broad market loses altitude like this, the next question is whether growth leadership can absorb the pressure or starts to crack with it. After SPY showed the broad market under pressure, QQQ tells us whether leadership can still hold up. And right here, the answer is getting shakier. This chart shows the falling wedge setup has been invalidated because price closes below wedge support and cancels what had been a bullish recovery structure. That matters because when a bullish pattern fails in the Nasdaq 100, it usually means buyers are no longer getting the benefit of the doubt. If yields stay firm and the macro backdrop stays tense, this broken setup keeps the pressure on big tech first. The next layer is the drawdown itself. QQQ now closes at a fresh 5% plus pullback low on Friday, March 20th, with the decline sitting around 8.1% from the swing high. So compared with the S&P 500, the Nasdaq is taking the hit harder, which is exactly what you would expect when long-duration growth gets squeezed by higher rates and weaker confidence in quick easing. If that macro pressure keeps building, a new pullback leg would tell you leadership is not stabilizing yet. Zooming out, the longer trend is still alive, but it is clearly under stress. The 50-day average remains above the 200-day, so the golden cross structure is technically still in place, yet prices slipped about 1.8% below the 200-day average. That is a much more fragile position than a normal pullback, because the long-term support zone is no longer comfortably holding. And that sets up the next chapter perfectly, because if crude keeps repricing inflation risk higher, this support test in tech gets even harder to defend. After QQQ showed leadership under pressure, crude is where the macro shock becomes impossible to ignore. This chart says ATR is sitting in the upper 98th percentile of the past year, and historical volatility has surged to 81.7%. In plain language, oil is not just moving higher, it is moving violently enough to reset inflation fears and risk appetite across markets. That is why crude becomes the cleanest outside driver of the week. If the supply story stays tense, this level of volatility can keep forcing investors to price a tougher macro backdrop. The next chart shows how strong the move still looks even after the initial spike. Price is sitting right at resistance near 97.89, momentum is bullish, RSI is up at 70.8 and rising, and crude is still above the 20 days, 50 days, and 200 days averages. So buyers clearly still have control, but this upper zone is now the decision point because repeated resistance holds can trigger a sharp pause if follow-through fades. If the war-driven energy story keeps intensifying, a clean break here would make the inflation impulse harder for the broader market to dismiss. Zooming out, the bigger message is that crude is no longer acting like a short-lived bounce inside a weak trend. The 50 days average has been above the 200 days for 11 days, which puts crude into an early stage golden cross and points to a possible longer trend shift higher. That does not mean oil has to run in a straight line from here, but it does mean the market has to take the inflation signal more seriously than it did a week ago. And that is the right bridge into yields, because once oil starts threatening a more durable rise, the bond market has to decide how much tighter financial conditions need to become. After crude repriced the inflation debate, the 10-year yield shows how the bond market is absorbing that shock. This chart puts TNX above its rising trend channel, trading about 2.5% beyond the upper boundary, with RSI at 71 and still rising. In plain language, yields are not just drifting up. They are breaking higher in a way that tightens financial conditions and keeps pressure on equity multiples. If oil stays firm and the Fed keeps sounding cautious, holding this upper band near 4.28 keeps yields in breakout mode instead of slipping back into a calmer range. The next chart shows how forceful that move has become. RSI is now above 70, which confirms very strong upside momentum, but it also tells you pullback risk is higher from here. So this is not a call for yields to rise in a straight line every day. It is a signal that the market repriced fast enough to keep the Fed and valuation pressure front and center. Zooming out, the bigger picture is where the policy tension really shows up. TNX is still technically in a death cross, with the 50 days below the 200 days. But prices move back above the 200 days by about 4.8% and puts that older bearish structure under real strain. That means the longer trend in yields has not fully flipped yet, but the odds of a broader reversal are clearly rising versus last week. And that is the right handoff into Nvidia, because once long rates stop being friendly, the market has to see whether AI leadership can still carry growth sentiment. After yields tighten conditions, Nvidia becomes a real test of whether the market still wants to own growth leadership. This chart shows Nvidia sitting right on support near 72.7 now, with the latest candle respecting that line, so a bounce is still possible while support holds. But the setup is far from healthy because price is below the 20 days, below the 50 days, and below the 200 days, while RSI sits at 37.8 and is still falling. So the stock is trying to stabilize, but it is doing that from a weak position rather than from clear strength. If the macro pressure eases, this support can produce a relief move, but if it breaks, the bearish trigger stays active. The bigger warning is that Nvidia is no longer just wobbling inside a normal dip. This chart marks a fresh 10% plus pullback low on Friday, March 20th, with the drawdown at about 11.7% from the swing high. That puts the stock firmly in correction territory and tells you investors are demanding a much better price for AI leadership than they were a few weeks ago. If the market keeps treating higher yields and oil-driven inflation risk as a headwind, this pullback can keep defining sentiment even with strong AI interest in the background. Zooming out, the long-term trend has not fully broken, but it is clearly more fragile than it looked in the previous video. The 50 days average is still above the 200 days and has been for 184 days, so the golden cross is technically still in place, yet price is now about 3.2% below the 200 days average. That is a much more serious warning sign, because the stock is no longer just below short-term resistance, it is pressuring a major long-term trend line. And that is the right setup for the economic calendar, because the next round of macro events will help decide whether leadership can recover from this stress or slips into a deeper trend reversal. After Nvidia showed how fragile leadership has become, the calendar tells us what can move the tape next. This image is very focused, but it still matters because every listed event is marked high impact. First up is Fed Chair Powell speaking on Saturday, March 21st, which keeps policy communication live right after a week where yields and inflation worries were already front and center. Then on Tuesday, March 24th, markets get both the S&P Global Manufacturing PMI and Services PMI with prior readings of 51.6 and 51.7, so investors will be watching whether growth signals stay steady or start to soften. If Powell sounds cautious and the PMI data holds up, yields can stay firm and keep pressure on valuation-heavy parts of the market. But if the tone softens or the activity data cools, that could give risk assets some room to stabilize after a very tense week. That is the real takeaway from March 16th through 20th. The market is dealing with an oil-driven inflation shock, firmer yields, and leadership that is still trying to hold but looks more fragile than it did last week. So the bigger trends are not fully broken, but the margin for error is clearly smaller now. If the macro tone steadies, markets can stabilize. But if energy pressure and rate stress stay elevated, this correction can keep grinding. Thanks for watching. That was your weekly market recap for March 16th through 20th. Stay sharp, manage the risk, and I will see you in the next one.